Welcome to Talk Tickers. We cut through the earnings call noise to bring you the insights that really matter for investors like you.
That's the goal.
Today, we're diving into Park Hotels and Resorts first quarter 2025 call.
Right.
So, the quick version. RevPAR, that's revenue per available room, it dipped slightly, 0.7%. But, that's compared to a really strong quarter last year.
Yeah, tough comp, as they say.
Exactly. Occupancy was down a bit, but they managed to push up the average daily rate, the ADR.
Offset some of that occupancy drop.
Total revenues hit $68 million, adjusted EBITDA $144 million, FFO per share 0.46 cents. They also kept the dividend steady at 0.25 cents.
Which is about a 10% yield annualized.
Right.
Pretty substantial.
It is. But they did trim their full-year RevPAR forecast slightly, now looking at Megafid 1% to plus 2%.
And that seems mostly tied to Hawaii's slower recovery and maybe some softer transient demand overall.
That's the gist. So let's get into the weeds a bit more.
Okay. Well, like you said, it wasn't all negative. There were some definite highlights, some parts of the portfolio doing really well.
Right, let's start there. Where did they see strength?
Orlando was a big one. The Bonnet Creek complex, specifically the Waldorf Astoria there, saw RevPAR jump 32%.
Wow, 32%.
Yeah, huge. And apparently that was driven by a 65% surge in transient revenues. So leisure travel seems very strong there.
Okay, where?
Key West also looked good. Casa Marina Resort, RevPAR up 12%. And then, solid gains, better than the industry average in places like Miami, New Orleans, Puerto Rico, D.C., even San Francisco.
So a pretty diverse set of markets performing well then.
Exactly. It shows strength isn't just concentrated in one spot, aside from the big Hawaii issue, of course.
Okay, let's talk Hawaii. That Hilton Hawaiian Village recovery, it's dragging things down quite a bit.
Oh, significantly. They quantified it a 420 basis point drag on the whole company's Q1 RevPAR just from that hotel's slower ramp up post-strike.
Oof.
Yeah. Overall, Hawaii RevPAR was down 15% in Q1. It got a bit better in April, down only around 7%. But they're still expecting, high single-digit, maybe low double-digit declines for Q2.
Just still working through it.
Still working through it. They expect positive growth, maybe mid-single digits by Q3. But it's a process.
And wasn't there something about international travel impacting Hawaii, too? Not just the strike fallout.
Correct. They mentioned softer inbound travel from Japan, which was down 6%, and also Canada down about 1.5%. U.S. domestic travel was flat, interestingly.
So it highlights that exposure to international markets.
Definitely. Fluctuations there could really move the needle for their Hawaii assets.
Okay, shifting gears a bit, what about their strategy? Investing for the future, that sort of thing.
Yeah, they're definitely spending over $80 million just in Q1 on capital improvements. The plan for the full year is $310 to $330 million.
That's a fair chunk of change. Any major projects?
Several. More renovations in Hawaii, second phase stuff, also the Hilton New Orleans Riverside guest rooms, and then the really big one, a $100 million renovation of the Royal Palm South Beach in Miami.
$100 million on one hotel.
Yep, a transformative one, they called it. They're projecting like 15% to 20% returns on that investment. They think it could even double the hotel's EBITDA once it's all done and stabilized.
So a high conviction bet on that property.
Seems like it. And speaking of Hawaii again, they're not just renovating, they're looking to expand.
Ah, the new tower.
Exactly. The 515-room tower expansion at Hilton Hawaiian Village, they got city council approval, conditional, but still a big step. Expecting final administrative sign-off by year-end.
Shows long-term confidence in Hawaii, despite the current issues.
Absolutely. Plus, on the portfolio management side, they're still active. Bought back about 3.5 million shares in Q1.
Returning capital to shareholders?
Right. $45 million worth.
Yeah.
And 11.5 million shares over the last year. Yeah. Suggests they see value. Maybe a disconnect with private market values.
And asset sales. Are they still trimming the portfolio?
Yep. Still aiming to sell $300 to $400 million more of what they consider non-core hotels. They mentioned several are being marketed, one pending sale at attractive pricing.
They've been doing that for a while, right? Selling off assets.
Yes. Since 2017, they've sold 45 non-core hotels for over $3 billion. It's a consistent part of their strategy focus on the core assets.
Okay. Looking forward then. What's the vibe for the rest of 2025, especially in those key markets?
Orlando, they sound very bullish. Group revenue pace is up 9%, and they're banking on tailwinds from, the new Universal Epic Park opening eventually.
Right. That's going to be huge for the area.
You think the Bonnet Creek complex alone could do over $90 million in EBITDA this year. Key West, also expected to stay strong.
And Hawaii, long term.
Long term, they're very positive. They keep pointing to limited new supply on the islands and the eventual inevitable recovery of Japanese inbound travel.
And the renovations are helping already.
Apparently so. They said renovated rooms there are getting rate premiums of 25% to 30%. That's significant.
But near term, there's still caution.
Yes, definitely. They mentioned uncertainty around global trade, geopolitical stuff, leading to shorter booking windows for transient stays. April RevPAR growth was okay, 1.6%, but it was a mixed bag. New York, Orlando, SF strong, others weaker.
So that revised guidance for Q2, flat RevPAR?
Right, that's about 290 basis points lower than they initially thought. And they said Hilton Hawaiian Village accounts for like 80% of that reduction.
Okay, so it really is mostly Hawaii dragging down that near-term outlook.
Mostly Hawaii, plus the disruption from the Miami renovation at Royal Palm South Beach. That's expected to take about 110 basis points off the full-year RevPAR growth.
Got it. And are they managing costs tightly given the revenue picture?
Seems like it. They highlighted comparable operating expenses were only up 1% in Q1 if you exclude some one-time credits from last year. That's pretty good control.
So confidence levels vary market by market.
For sure. Strong long-term belief in Hawaii. Orlando expected to power ahead. Key West, Curacao looking good. New York, cautiously optimistic, they said, given the limited new supply. Denver, hoping for improvement with management changes. It's not a uniform picture across the U.S.
What about demand segments? Group versus leisure versus business?
Group pace for Q2 and Q3 is actually a little soft flat, down 1% for Q2, down 10% for Q3. Partly tougher comps in Hawaii again. But Q4 group pace looks really strong, up 18%.
Okay, so back half loaded for group.
Seems that way. Definite bookings are holding steady, though. Leisure transient looked good in April, especially resorts outside Hawaii, up about 8%. Business transient's okay, just those shorter booking windows make it harder to predict.
Anything else stand out from the call? Any little nuggets?
Well, the Miami renovation timeline, they seem confident it'll be done before the World Cup next June. That's a key deadline.
Ah, good point.
They also defined attractive pricing for asset sales.
Yeah.
Basically getting multiples better than where their stock trades, saving on future capex they'd otherwise have to spend.
Makes sense.
Oh, and non-rooms revenue, like F&B, grew faster than RevPAR in Q1, up about 200 basis points ahead, helped by group catering, which is up 9%.
So groups are spending while they're there.
Exactly. They also took a $70 million impairment charge on some asset, didn't specify which one. And they addressed the Hilton Hawaiian Village loan maturing late next year, said they have a plan, options, feel confident they can handle it.
Okay, that's a really thorough breakdown. So let's move to our favorite segment. This is not financial advice. Time for a slightly out there idea based on all this.
All right. So we talked a lot about Orlando's strength, right? The theme parks, Bonnet Creek doing well, Epic Universe coming. Instead of just playing the hotel angle, what if you looked at the companies actually building the rides? The ones creating those super immersive high-tech experiences for Epic Universe and maybe future Disney stuff.
Interesting, like the tech suppliers behind the magic.
Yeah. Exactly. A sort of pick and shovel play, like you said earlier. It's a bet that the whole Orlando entertainment ecosystem grows even faster than expected. And these specialized tech suppliers capture a big chunk of that upside. It's tangential to park hotels, but leverages that same Orlando growth story.
A speculative bet on the future of theme park tech in a booming market. I like it. Creative.
It's an idea, of course.
Of course. Well, that wraps up our deep dive on park hotels and resorts Q1. Lots to think about there.
Definitely.
Remember, everyone, this is purely informational. It's not financial advice. Please do your own homework, dig deeper, and form your own conclusions.
Absolutely.
Thanks for tuning in to Talk Tickers.